Understanding liquidity risk, implications for banks, corporations, and individuals. Liquidity risk is a critical financial concept that refers to the potential challenges faced by institutions, corporations, and individuals in fulfilling their short-term financial obligations due to inadequate liquidity. It represents the risk of an entity being unable to obtain necessary funds, whether from customer deposits, borrowed funds, or liquidating assets, at a reasonable price or within a required timeframe. The consequences of unmanaged liquidity risk can be severe, affecting operational stability and overall financial health. Key aspects of liquidity risk. Liquidity risk can manifest in two primary forms: market liquidity risk and funding liquidity risk. Market liquidity risk. Market liquidity risk arises when an organization is unable to execute transactions at current market prices due to a lack of market depth or disruptions. For instance, if an enterprise needs to sell large quantities of assets, the market may not be able to absorb them without significantly lowering the price, leading to potential financial losses. Funding liquidity risk. Funding liquidity risk occurs when an entity cannot secure sufficient funding to meet immediate financial obligations. This can result from mismanagement of cash, external credit conditions, or sudden withdrawal demands by depositors. A common situation is when companies face unexpected expenses or downturns, creating gaps in their cash flow. The importance of liquidity risk management. Managing liquidity risk is essential across various sectors. For banks and financial institutions, adherence to stringent regulatory frameworks, such as Basel III, is necessary to maintain liquidity standards and protect depositors. Corporations too have to prioritize liquidity management to ensure their ability to meet operational demands. Key takeaways about liquidity include: liquidity's vital role. Institutions must manage their liquidity to avoid financial distress during normal and turbulent market conditions. Regulatory oversight. The regulatory landscape emphasizes the necessity of maintaining adequate liquidity and ensuring financial resilience. Consequences of poor management. Failure to address liquidity risk can lead to significant repercussions, including financial losses, operational disruptions, and even insolvency. Managing liquidity risk. Strategies for financial institutions. Banks and financial institutions use a variety of methods to manage liquidity risk effectively. 1. Portfolio of liquid assets. Maintaining high-quality liquid assets, HQLAs, allows instant access to cash when needed. 2. Liquidity ratios. Employing ratios like the liquidity coverage ratio, LCR, and net stable funding ratio, NSFR, assists banks in ensuring they can meet cash outflows in stress scenarios. 3. Stress testing. Conducting simulations of adverse market conditions helps banks identify potential liquidity vulnerabilities. 4. Diversified funding sources. Relying on multiple funding sources minimizes dependency on any single channel or source of capital. 5. Cash flow management. Effective monitoring of inflows and outflows ensures liquidity needs are adequately met. Strategies for corporations. Corporations face unique challenges in managing liquidity risk compared to banks. Here are common strategies to minimize liquidity challenges. 1. Revolving credit facilities. Establishing lines of credit with banks can provide immediate funds if required. 2. Cash reserves. Maintaining a buffer of cash to cover unexpected expenses is a prudent move for any corporation. 3. Cash flow forecasting. By accurately predicting cash inflows and outflows, companies can identify potential shortfalls and address them proactively. 4. Funding diversity. Using a mix of equity, debt, and trade credit helps stabilize liquidity and avoid overdependence on one funding source. The broader implications of liquidity risk. Liquidity risk is not just limited to individual institutions, it has broader economic implications as well. For example, during crises such as the 2008 financial meltdown, liquidity shortages in major banks led to a credit crunch, affecting businesses and consumer spending across the economy. Similarly, liquidity problems in larger corporations can lead to layoffs, reduced consumer confidence, and a negative ripple effect throughout economic sectors. Conclusion: liquidity risk is an omnipresent threat for banks, corporations, and individuals alike. It is imperative for all stakeholders to effectively manage liquidity to ensure they meet short-term financial obligations and maintain stability. By implementing robust liquidity risk management strategies, ranging from maintaining sufficient cash reserves to engaging in thorough cash flow forecasting, entities can better navigate financial challenges and foster a more resilient operational framework. As financial markets continue to evolve rapidly, proactive liquidity risk management will remain crucial for safeguarding the financial health and sustainability of both institutions and individuals.